Welcome everyone to Vested Interest. This is Shane, and before getting into the video, I'd like to take a moment to thank everyone who's taken the time to watch, comment, and like the videos, and a special thank you to those who subscribe to the channel. I really do appreciate it. The channel continues to grow because of people like you, and if you are tuning into the channel for the first time, hit that subscribe button down below. Join us on this journey to financial freedom. Join the Vested Interest community. Comment if at any time you find value in the video. We are going to be covering a portfolio update. I did add $1,727 to the portfolio. I do these portfolio updates every Sunday morning, showing you exactly what I've bought and sold in the portfolio, any dividends I've received, any options that I'm running, all out in the open, no paid Patreon, no firewalls to go through, no other sites to visit. I'm not trying to sell you a course or anything. I do this every week to hopefully motivate anyone out there who is thinking of starting a portfolio to do so. I think dividend growth investing is the best way to financial freedom. I did not grow up with a background in finance with two parents who are wealthy or have anything to do with the financial community. I am just a regular guy who goes to work Monday through Friday. I've got 2 kids. I'm married. We've got 3 dogs. Just your typical average everyday American here. And if I can do it, I know you can do it too. It just takes a little bit of math skills and the ability to be consistent, putting your money away, living within your means, setting a budget, living within that budget. That is the idea. And then eventually, over time, investing your money into dividend growth stocks, you will be able to live off of the dividends. That is what I'm doing, and that's why I put this out every Sunday so that you can see how a real portfolio is built out over time. And again, if you're new to the channel and you are interested in this kind of content, hit that subscribe button down below, hit the notification bell so you're notified whenever we put out any new content. We did add $1,727 to the portfolio. Let's jump right in. And we will start out here on December 5th. We did run 2 contracts on Bank of America with an expiration date of December 15th, a $30 strike price, and we received $44.94 in options premium. So this goes right back into the portfolio, and either these options will hit on the 15th or we'll continue to run this wheel and put out another cash secured put just like this one here. So those funds are set aside to run this wheel on Bank of America. Again, December 15th expiration date with a $30 strike price. It's a little bit above that right now, so it looks like these will probably expire worthless. We'll keep the options premium and then we'll run another wheel for the next week. But we'll see. It is a week out still. So $44.94 added in options premium. Next up, we're going to get into the first dividends paid out of the week, and we did receive quite a bit in dividends, a little bit over $450 in dividends this week. Right here, we're going to cover $194.48, and that covered the payout from Enbridge, ticker EMB, out of the energy sector, paid us $106.55. And I have the drip set, so that means that anytime a company pays out dividends, it goes right back in and buys more shares of that company. So you can see here these $106.55 went right back in and bought 3.03048 more shares of Enbridge. And we received $87.93 from Pfizer, ticker PFE, out of the healthcare sector. And those funds went right back in and bought 2.97362 shares. And these new shares bought by the dividends paid out added an additional $12.99 in passive income over the next calendar year. So that is that snowball effect, right? We've already put money into Enbridge and Pfizer. Now those shares that we already own of Enbridge and Pfizer are paying us dividends. Those dividends are buying more shares, and those additional shares are adding more passive income. That is the dividend snowball growth effect right there in front of your eyes. Next up, on December 5th, we received more dividends, another $267.43. Like I said, we received a bit over $450 this week in dividends, and this $267.43, part of it came from LyondellBasell Industries, ticker LYB. This is out of the materials sector. We received $142.86, and just like we saw on the previous page, these funds went right back in, bought 1.53564 more shares of LyondellBasell. And Johnson & Johnson, ticker J&J, out of the healthcare sector, paid us $124.57, went right back in and bought more shares of Johnson & Johnson. Not quite a whole share, but 0.78506 more shares there. So just under 1 share of Johnson & Johnson. And those additional shares added $11.40 more in passive income over the next calendar year. Now we get to the first investments of the day. It says November. That's not correct. It was on December 4th. We added 2 shares, a whopping 2 shares to our Nutrien position, ticker NTR. This is out of the materials sector as well. And this is a Canadian company, so it also has some tax implications. $108.76 invested on December 4th, adding $4.24 in passive income from these 2 additional shares. And here's where the meat and potatoes of the week really came in. We added $1,618.68 on December 7th. I should have updated that from December 1st. This was last week's edition. So on December 7th, we added this $1,618.68. And that is broken up into several different positions. We added 8 more shares to our Kroger position, ticker KR, out of the consumer staple sector. $358.16. We picked up those shares at $44.77 per share. We added 10 more shares to our Cisco Corp, ticker SYY, also out of the consumer staple sector. Picked up those shares for $74.19. And we're real close to being at 100 shares with Cisco Corp. I think I've got another 5 to add next week, and then we're at 100, so we might back off this one a bit. It has run up quite a bit, and we're right at the top of where we want to be paying for our 15% of our 52-week low. So again, I'm going to add those 5 more shares and back off of it, just like we did with Haverty. We got Haverty to 100 shares. We're backing off that one as well. That one has really run up, and you can see that's the next one that we bought. So these 10 shares that we added to Haverty Furnitures Companies, ticker HVT, we picked them up at $32.55. This puts us at 100 shares, so we're going to back off this one. 5 more shares to go here, and then we'll be focused on building out the Kroger positions. These are the 3 newest positions in the portfolio, Kroger being the newest. And last but not least, we added 4 shares to Cisco Systems, ticker CSCO. This is out of the information technology sector. We picked up those shares at $48.29. All total, these new shares here, adding to existing positions, added $47.52 in passive income over the next calendar year. All total, we added $1,727.44 in new capital to the portfolio, picking up an additional $76.15 total. So that was from the dividends paid out that we saw, as well as the new capital and the new position, or the new shares that we picked up as well. Let's jump over to the sector weighting. Communications is sitting at 9.47% of the portfolio. Consumer discretionary makes up 1.91%. Consumer staples starting to get up there with the Kroger additions, the Cisco Corp additions, and Procter & Gamble. If it stays under my cost basis, I'll probably be adding that to that one as well. So this is going to creep up here a little bit, and I don't mind that. I like the consumer staples sector right now. Sits at 10.01% of the portfolio. Energy makes up 6.62%. Financials sitting at 8.52%. Healthcare makes up the largest chunk of the pie here at 17.57%. And I'm probably going to add a little bit more to Pfizer. J&J pulled back a little bit, so if it stays low, I might add just nibble there, 1 or 2 shares here every now and again. And I may add to CVS, though that one has run up a bit. I added 4 shares last week, but I might back off that one a little bit unless it pulls back a little. It's kind of getting above what I want to add, the cost basis I want to add to there, but we'll see. So this one's pretty close to being above the 20% I'm looking for, or at the 20% I'm looking for. I don't want any one sector over 20% of the portfolio. So I really need to watch this one, but those particular positions I do want to add a little bit more to. Industrials makes up 8% of the portfolio. Technology is sitting at 7.89%. Materials is sitting back in second place. It's been jockeying between materials and REITs for second place. So materials makes up 12.62%. Utilities sitting at 5.12%. And REITs and real estate at third, sitting at 12.28% of the portfolio. No ETFs. I'm not against ETFs. I do have some ETFs in my daughter's account. I like SCHD. I have VWO, which is an emerging markets ETF, in their account, and I am watching VUG for a pullback. Whenever it pulls back to a more attractive buying price, I'll add that to their portfolio as well. So if you are not willing to do the due diligence and really dig into the meat and potatoes of individual stocks, index funds or ETFs is the way to go. I would always recommend like a VOO, which is the S&P 500. SCHD is a pretty good one for dividend growth investors. Like I said, if you want something in the emerging market sector, I like VWO. That's a good one. And a tech or growth sector would be VUG. There are other ones out there, but those are the 3 that I really like. Low expense ratios, pretty low. I think VWO would be the highest of the three. But those are three that I would recommend. And like I said, I've got two of the three in my daughter's custodial accounts, with the third I'm just waiting for a good buying price. Over here to the right, you can see the portfolio sector weights. You can see the percentages match up with the pie breakdown here, and I've also got the dollar amounts allocated to each section as well. Now here it is. This is the overall portfolio. I show this every week, whether I'm up, whether I'm down, whether the market is floating sideways. I'm going to show you what a real portfolio looks like, so you can see all the ups and downs as well. You're going to have some red, you're going to have some green. Sometimes you're going to be up, sometimes you're going to be down. That is all part of investing. I do not focus on this part as a dividend growth investor. I focused on this part. I don't want to sell any of my shares. So the only way you lock in a gain, like WSM, I'm Williams and Sonoma, I'm up 60.64%. I'm not interested in selling it. I'd actually like to pull back down to my cost basis at 121. It's way up at 194. I'd actually like it to pull back towards my cost basis so I can add some more, since I only have 2 shares. Another one, right? Owens Corning, 44.578 shares. I'm up 56% there. Unless I sell this, I have not made 56.06%. I'm focused on the dividends it pays out, right? So that's what I'm focused on this portfolio. I don't ever want to sell the positions unless there's something wrong with the fundamentals of the company and the reasons that I invested in the company changed. Then that would be a reason to sell. Here are the tickers, all the positions in the portfolio, how total shares I have, current price as of the close of business on Friday, market value, right? The shares times the current price is all that is. My share cost per share right here, my purchase price, how much I have into it, and that's just my share cost times how many shares I have. Total return, whether I'm up or down in this column. Percent return, whether I'm up or down in this column. What sector the company falls in, whether it's a quarterly, monthly, semi-annual payer right here. Current dividend yield as of the close of business on Friday. Yield on cost, my yield on cost. Portfolio weighting. So on the previous sector, we saw the sector weightings. This is for each individual position. And let's talk about that. I don't want any one position to be over 10% of the portfolio either. So J&J in the healthcare sector is sitting at 8.69%. It's the largest piece. So I'm pretty close to being over with adding there. But again, it's still under my cost basis at 154. My cost base is at 161. I can buy it all the way up to 166. I might run this up to 110 to 120 shares. Might nibble a little bit here and there, so long as it stays under my cost basis, bringing my cost basis down, bringing up my dividend income, and bringing up my dividend yield as well. Here is the portfolio weighting. Like I said, annual estimated income in this column, what months they pay out, dividend growth year over year, and where they sit at 15% of their 52-week low. Let's talk about this one. Let's use Cisco Corp as an example, right? I'm sitting at 95 shares. I want to get this to 100 shares. So I'm at $67.90. That's my cost basis. It currently is selling for $73.80. I can buy it all the way to $71.57. So it is over 15% of its 52-week low. But since my cost basis is so much under where it sits at 15% of, I am willing to add these last 5 shares. Even though that 73.81 is over 71.57, I'll add those 5 more shares, knowing that this is probably going to take me up to 68.20 or 68.30 per share, and my cost basis will still be a few dollars under where it sits at 15% of its 52-week low. So I know that technically I shouldn't be adding to SYY because it's over where I want to pay at 71.57. But since my cost basis is so low, I'm willing to add a few more shares, the 5 more shares to get it to 100 shares, and then I'll back off of it. It's just kind of a way to look at it. You've got to have a price that you're not willing to pay over, but don't let that be such a hard and fast rule. It keeps you from adding to a position you might want to otherwise add to. Cisco is one of those in that situation. That's why I wanted to talk to that. Now, currently I have 5,700.664 shares. Market value is sitting at 190,000, almost at 200,000. Boy, might have to do a special video whenever I pass the 200,000 mark for the portfolio. Very, very nice to see that it's really starting to grow, really starting to see the fruits of the labor of the patients, consistently investing week after week into the positions in the portfolio. My money that I have into it, right? I have $192,689.68. I am down $1,691.83. But again, remember, you are not down or up. You have not made any profits and you have not made any losses unless you sell the shares, right? Unless I start selling these shares, I'm not locking in any gains or any losses. I am down technically 0.88%. If I was to sell everything, liquefy the portfolio, I would be down this $1,600 and almost $1,700, but I'm not planning on doing that. I'm planning on holding. So eventually this will all turn green and it'll be significantly in the green, 10, 20 years from now, most likely. My cost basis, or I'm sorry, my current dividend yield is sitting at 4.695%. My yield on cost is 4.654%. And this is what I am focused on. This is what it's all about, whether the market's up, whether the market's down, whether the market's floating sideways. Again, whether my portfolio is up or down, the passive income, the dividend income paid out by all the different positions in the portfolio consistently grows week over week, month over month, quarter over quarter, year over year as I add more capital, as I make options contracts and add that capital in as well. And then as you saw, as positions in the portfolio pay out dividends like Pfizer did, right? Pay out dividends, buy more shares, and that increases this as well. And then also when companies raise their dividend, Enbridge recently raised its dividend by 3%. So when companies raise their dividend, that also increases that snowball effect. And it currently sits at $8,968.22, going to probably bust over 9,000 next week. Very, very good to see this growing. I'm very, very excited about this, right? I am very, very close to busting over 10,000 into that five-figure, 5-figure income. And then from there, the next goal will be to at six-figure. Obviously, it'll be, to 10,000. Then we'll have a goal of maybe 25,000, then a goal of 50,000. But really, the next big one would be the 100,000 mark when we're making 100,000 in dividends. And I know that may be a far out goal, way out into the future, but eventually, if we continue to do what we're doing, we will get to 100,000 a year in dividends. And the dividend growth is growing at 7.33% a year. Now, this is not exactly accurate because this would need to be, I'd need to do the math and set up the weightings. Williams and Sonoma, right, is growing at 26.03%, but that has a lot less impact since it's such a small position than, let's say, a Verizon, which is only growing at 1.94%. So this is probably a little bit misleading. It's probably a little bit lower than this. It might be around the 4 to 5 or 5 to 6%, but these are not weighted based on the size of the position. That just gives you kind of an average estimate. Well, that is it for this week's portfolio update. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Again, if you have not done so, it really does help out a small YouTube channel like mine to hit that subscribe button down below, hit that notification bell, hit the thumbs up, drop a comment. All those things really help get the word out. Let's spread the message. Dividend growth investing, like I said, in my opinion, hopefully in your opinion as well, that may be why you stop by the channel if you are new to the channel. Dividend growth investing, the dividends, passive income provided by dividends is the best way to eventually reach financial freedom, get off the hamster wheel, that 9-to-5 grind that we all are kind of trapped in unless you were born into a wealthy family and have a bunch of money and live in the good life, which kudos to you, thumbs up to you if you are. I did not have that luxury. Again, neither one of my parents graduated high school. I didn't come from a financial background. So I am learning along the way. I'm sharing what I learn along the way, and hopefully that helps someone out there take that next step and become an investor yourself. You can do it. Don't let the lack of knowing exactly what you're doing or not having a background in it deter you. It is not just for the rich and wealthy and rich and powerful. Dividend growth investing, in my opinion, is for anyone. And if you are a little intimidated, take that first step and just jump into index funds and ETFs. VOO is a good one. Just dollar cost average into it every week, every month, every quarter, whatever you can afford, and start that journey to financial freedom. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. I do a stock pick of the day series for those of you who are new as well, Monday through Thursday, where I cover a company stock that's pulled back on the day, see if there's any value. So if you have a company you'd like me to cover, go ahead and tune back in, drop that suggestion down in the comment section. I'll work it into the rotation. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing in for educational and entertainment purposes. Investing involves risk and can lose money and should never invest any amount you're not comfortable losing. Always do your own research, invest based on your situation, circumstances, and select criteria, or seek the advice counsel of a certified financial advisor.